Hey traders, welcome to Charts and Coffee. Great to see everyone. Welcome to your pre-market brew. All right, gang. Great to see everyone. Time to caffeinate and dominate on this Friday morning. So let's get to it. Let's take a quick peek at what's going on the charts. I'm using some TradingView charts this morning. And yes, my two favorite charting platforms in terms of, kind of looking at the visual that is, this is the interface from which we make our decisions. So I like TradingView because, it works great on this thing. And I'm able to walk away from the desk, take a look at my indicators on charts. So big fan of this. It's a broker agnostic platform. So I'm just giving y'all a breakdown for those of you that may not be familiar with it. I don't know the folks at TradingView. I've just been a big fan for, I guess, coming up on 8 or 9 years at this point. And it is a great web-based platform. And then, of course, I've got my Think or Swim charts. All right, so we're going to use some TradingView, tackle some questions, take a quick pit stop over at the economic calendar. Quick reminder, if you didn't check this one out, in fact, this week in my free videos, I thought, you know what? Let's focus on the negative. I know, so positive, right? It actually is. If I know where the pitfalls are on my path as a trader, I've got a better idea of recognizing them. I've got a better idea of not falling in them. But look, gang, I've fallen in them before. So, we all have friends who, when we've fallen in the pit, will either just jump in with us, go, okay, we'll just commiserate together. Nice, but not super friendly, not super helpful, but friendly. But we have others that'll jump in and say, look, I've been here before and I know the way out. And I hope that the videos this week have been the latter. Today's trading don'ts. All right, that was yesterday's free video. Whether you're a member, whether you're not a member, you can check that out right here at the Simpler Trading YouTube channel. And what were the don'ts? Well, it was, I was kind of going back and forth with Trish. We were thinking, should it be the do's or should it be the don'ts? And the do's were, are you paying attention to the clock, right? Day trading. It's not as much a calendar, although, of course, we want to be keeping an eye on what's going on in terms of the hot zones that we're dealing with. What are hot zones? Scheduled, high impact, high volatility economic releases. We have one today. I call them hot zones because I guess it's coming up at about 20 years. Forex Factory has been around forever. And I love this calendar because it's a global calendar. It reminds us that there are markets that open before the US market. And there is risk appetite or risk aversion that we're inheriting oftentimes as early as, say, 7 a.m. Eastern and clearly into the 9:30 bell. So it's good to know what those are rather than looking at the 9:30 bell as the beginning of trading. It really isn't. It's the beginning of stock trading. But remember, currencies have been trading, largest market on the planet. Futures have been trading. Futures are a massive market. And then stocks join the party. So if we know what's been happening, we know it's going to potentially shift sentiment, like the preliminary University of Michigan consumer sentiment. We won't be caught off guard when these massive events happen, these volatility database releases. And please remember, of course, that there are plenty of events that are going to occur that are not on the calendar. And they're not events that we can prepare for because, we don't see them coming. However, they're going to happen. And what I mean by that is geopolitical events, sound bites, things that are just hitting the market because someone said something. Fed speeches are also mostly scheduled, but, a Fed member could say anything. And of course, the media is going to cover it. That could move the market. Don't be as upset about those. Just know those things are going to happen. All right. So that's kind of where my focus is today. We've been talking a lot about the target rate probabilities. If you have not been keeping up with that conversation here at Charts and Coffee or in the free videos, I talked about that one on Tuesday. What do the Fed target rate probabilities look like now with CPI and PPI? And then what are they going to look like after consumer sentiment numbers are released at 10 Eastern? As long as, and this is going to make it so easy, gang, we don't have to overcomplicate macroeconomic analysis. Right now is one place you can look, makes it really easy to not get swayed by whatever nonsense, and most of it is nonsense, gang, that's being talked about on the interwebs or on the TV, aka, as my mom called it, the dumb box. Growing up, by the way, I was allowed 1/2 hour of television a day, and that went till I got into college, and I'm pretty happy about that. It was a good thing. I hated it. I hated it at the time, but I'm really grateful that, when you're not watching TV, you pick up a book or something, right? Or you go outside, heaven forbid. All right. Target rate probabilities. What do we need to know? Blocking out the noise. As long as we are hovering around the 350 to 375 column on the December target rate probabilities. In other words, what is the rate going to be by the time the Federal Reserve, the FOMC, makes their decision about whatever hike we're going to get in December? Where is that rate going to be? It peaks and plateaus after December of this year. That's where it is right now. The gold medal right now is sitting with 350 to 375 basis points, which means 3.5 to 3.75 points. The silver medal, 325 to 350. As long as the columns more to the left of this graph are taller, stocks will like it. Period. That's it. That's it, right? I know how that this is why analysis gets so complex, because if I have a 24-hour cable news network that I've got to fill hours on, I can't give you a 30-second succinct answer, can I? But on a 20-minute show, we can. All right. So with all that being said, of course, let's jump into your questions, and let me move these charts a little bit out of the way so those questions will fit in here on the screen. All right, kicking it off. Hey there, NM. Love the show. Thank you. I love doing it. I appreciate y'all taking time in your morning and joining me for it. We're here every weekday, Monday through Friday, and then we're here Sunday evenings to kick off the new week on at 6 p.m. right here at the Simpler Trading YouTube channel. Let's see. You're in Allison's Profit Recycling Mastery. Cool. Allison's great. I really like Allison's focus on risk management. I really respect that. As someone who's been doing this for 32 years, and I look at traders who have early in their career, or, look, I kind of sit here like Auntie Raghee. So it's not in any way other than I've just been doing this for so long. And when I see a trader understand risk as the primary element to the mindset, I really love it. Is there a FedWatch tool that analyzes the probability of the increase in QT and at what rate? And you can dive into the FRED data at the St. Louis Federal Reserve. It's FRED, their data. But I would tell you, I'm not as concerned about where the asset purchases are right now. By the way, even as we were hiking rates, asset purchases have slowed, but they haven't stopped. So we're seeing purchases, but we're also seeing the unwinding of the balance sheet. So the reason I bring up that FOMC FedWatch tool from the CME is all of that is going to be distilled into what is the Federal Reserve going to do. And that really is the main driver for psychology. But I would check out that FRED site. You'll probably find that and a lot of other supporting data that will give you a better idea as to how you want to shape your macroeconomic model, if you will. All right. So thank you for the question. Tell Allison I said, hey. All right. Wondering, why did I choose a 5-minute time frame for day trading? Why not the 2, 3, or even 10? So Megazord, I used to use the 1 and 3. Now this would have been going back to 1997, 1 and 3. And also remember in 1997, what was happening with tech? It wasn't quite the 99, 2000, asset bubble that we saw, but 1 and 3 minutes were fine back then. I was able to get good clarity on my screen with that particular time interval. I use the 2 mostly even now, but not as a decision-making time frame. So I use the 2. I don't use 1. I don't use 3. There's 2 time frames that I'll look at. My decisions are made on the 5, and every now and then, I'll dissect the 5-minute time frame with a 2-minute, and then 2 minutes. 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 And then 2 min one of my mentors, and I've had some great mentors. I was thinking about one of my mentors just this morning. Um, he passed this year, and I guess I was thinking about him so much because he was the one that taught me what risk of ruin is. He was the one that said, kiddo, and he's the one that used to call me kiddo a lot. I think two of them used to call me kiddo, made me crazy. But he used to always say that risk of ruin is 50%. It's not blowing up your account. Consequently, I've never blown up an account because I was so programmed to think if you've taken an account of $10,000 to five, something is wrong. For crying out loud, stop. Stop what you're doing. And funny enough, later on, I did a mindfulness class. I guess MIT does this mindfulness class, and their process also is stop, right? Stop, and then there's the STOP was the acronym. It's no different for trading. 50%, heck, 25, it could just be volatility. Volatility could drive your account up or down 20, 25%, especially when day trading. But 50% is the mathematical stop what you're doing right now. All right. So he taught me that. The other thing that he taught me was the 2-minute time frame. I said, why the two? It's an unusual time frame back in 98, 99, 97. I'm trying to remember when I would have started to incorporate that more. It's been a minute. Anyway, I said, why two? And he said, it's smarter than the one and faster than the three. So I do like that 2-minute, but the 5-minute gives me the clarity that I prefer. Gang, it's preference. It's ice cream, right? I like vanilla. I don't like chocolate. And so it's not that ice cream's bad. I just have that preference. Please don't feel, and even though I'm using the 5, please don't ever feel that there's a magical holy grail, the best time frame. There isn't. It's what your tools relay visually with the most clarity. And where the clarity is, the confidence comes, and you can manage risk from there. So 5 is what I use, and it's where my clarity comes from. By the way, clarity has come from not 6 months or 3 months of, hey, this works really well. It's usually a year, right? Now, if you would have followed me in 18, 19, I was using the 2 and 1 a little bit more because we were in a different type of behavior in the markets. Things were a lot more parabolic and they were much more bullish. And when we have parabolic accelerated uptrends, a shorter time frame does tend to give a lot of clarity. That's just what I've found. So again, the 5, especially in chop, has been very good to me. All right. So thank you for the question, Megazord. I haven't been asked about time frames in a while, so thank you. Martha, good morning. Can I talk about the advantage of using at the money puts and calls versus out of the money when day trading with my approach? So remember, Martha, a lot of times, remember there's 3, think of it this way. Options are 3-dimensional vehicles. You're paying for time, how much time to expiration. You're paying for how close you are to current price. What is your strike in terms of proximity to current price? It's kind of location, location, location. You got a house by the beach, it's going to be a little pricier. So at the money, in the money is that house at or on the beach. And then you've got volatility, right? How volatile is the market movement? And that's also going to contribute to the expense or lack of expense for that option. I have found when I'm day trading, we need to make decisions fast, right? I don't believe in spreads when day trading. They take too long. And oftentimes they encourage traders to trade options that would otherwise typically be unaffordable by using the credit as an offset. Why not just trade affordable, lower cost options as you build your account, right? That's my theory. That's my philosophy. The at the money gives me usually about a 50 plus delta, 50 to say 70 at best, but about 50 delta. And the out of the money is far less. So if I'm already dealing with an option that's going to expire pretty soon, either Monday, Wednesday, Friday, or Friday's expiration, I don't have a lot of time value. And then if I'm going out of the money as well, I'm really putting myself at a deficit in terms of what kind of movement is going to be necessary for me to profit. At the money is easy. At the money is easy to communicate to my traders when we're day trading in the morning, and I'm in the morning with either my futures group or with my mastery every single morning, 9:20 to 10:35. It's just easier to communicate. It's easier to execute the idea without the minutia of, do I go out of the money this time? Do I go in the money? Do I go at? The fewer decisions and the more systematic it is, the better. And that's why I do that. It's easy and it's effective. And If I can put a check in both those easy and effective box, that's good enough for me. Thank you for the question. C asks, hey, how you doing, C Dan? I bought the 41.85 call yesterday in SPX. Okay. Looking at a decent return on the open. Yes. I'm learning to take profit. And if the charts indicate contours move 515, I'm not quite sure where the question is. See, Dan, you're doing call spreads. Cool, cool. Look, as long as you're moving with the path of least resistance, which clearly you are, a lot of times traders want to ignore that the market's bullish. And a lot of times when the markets are very bullish, I'll get a question of how can I buy puts? And my thought is, why would I want to step out in front of the freight train? So great trade, not stepping out in front of the freight train, good stuff. Once I finish my market overview, can I give us my view of gold? I can do that right now. Gold. All right. So end of day view, gold, not an uptrend, certainly bullish in terms of momentum. That's been the case since August 5. Still below the 200 propulsion. I'm not yet super bullish on gold. I really want to see the uptrend organize, which it hasn't yet. The momentum is bullish. That does then foreshadow possibly the transition to a trend, then going bullish, and then getting above the 200. I think we have a whole lot more clarity on what it is that I want to do next. Because quite frankly, still around 1820 to 1825, that would be technically, right? Technically meaning the structure of the market and where my slow stochastic is overbought. I will keep an eye on the real yields. That's going to be the story. Remember, again, when you're trading gold, please ditch the notion that gold is a flight to safety. Never has, never was. Listen to me now, believe me later. It's not inverse to the dollar. Consistently, correlations come and go. They weaken, they strengthen. What gold has the most consistent correlation to is the nominal yield of a bond minus the rate of inflation, otherwise known as real yield or real interest rate. Track that, which you can. You can Google real yield and find a graph. Chart that, and you'll see that gold moves inversely to that. All right? Shh, don't tell anybody. Don't tell anybody. The secret's out. Booking. Let's go take a look. Trying to turn into an uptrend, kind of in the same spot that gold's in. I don't want to be a bear anymore, gang. If you've been following my analysis, the free stuff, right? Since July 7, I said, look, gang, the bottom, the downtrending, this expectation of lower lows, we have to stop. I don't like to say the bottom is in, because sadly, that translates into most traders' minds as it's okay to buy anywhere and everywhere. Not true. Before we have a bottom that's quote unquote in, we need the downtrend to stop, which it did. We need to go to chop, which we are, and then the chop, if it can stabilize, encourages people to buy because they're much less scared. And on the other side of that fear is, well, maybe there's opportunity, but we got to stop the fear first, which we have. So booking's kind of in that spot where I don't want to short it, although it is bordering overbought. So I don't want to buy it up near the 200. But if we can turn into an uptrend, we'll start to buy the dip, Sue. Yeah, we'll start to buy the dip. From my perspective, has the bottoming process completed? MVC, it completed back on the 7th of July. Yeah, I think the title of that video was me trying to be a little clever. The light at the end of the bottom, July 7. And yes, not just yes, but that was the date. And check that video out if you want a little bit more detail on how I determined that over a month ago and what I was looking at. And I thought that was important enough a video where I didn't want to keep it behind the paywall. I wanted everyone to know because it was hopefully going to get people to stop shorting near the low and start building a bullish watch list, which is exactly what we've been doing in the Sector Secrets Mastermind. We've been, focusing on, all right, what are those bullish indices? NAS and S&P now. What are those bullish sectors? I think we have 6 or 8 of those now. And what are the stocks? I think we probably cumulatively have about 24 names that are now in uptrends. Some are below the 200, not as good. Some are above, much better. But we've got slowly that what I call double green watch list. It's growing. It's growing. And that's probably the most important thing that we can remember and take into the second half of this month and into September. I hope that makes sense. All right, Marla, how are you? Join Raghee on Wednesday. Oh, you're okay. Awesome. You were day trading with the mastermind. Awesome. Both Wednesday and Thursday, I made some money. Very happy with her. Oh, Marla, that makes my look. Tricia and I were talking yesterday, and when we're putting out a class, when we're putting out the updated schedule as we have in the Sector Secrets Mastermind, when we're doing that and we get feedback, we have a lot of feedback from members saying, it's finally clicking and I'm finally making some money. I can sit here in the quiet of my office with my dog, who clearly wants out of the office, and my cat, who could care less that I trade, and I could just sit here quietly and do well. But when the group does well, that just makes my day. That's why we do what we do with the mics and the cameras and everything else. So thank you. I really appreciate it. That just makes my heck. I think that made my weekend. We're going to be day trading right now, so I've got to go. We're going to head on over to the mastermind room. Let's day trade the morning, see what it brings. Heads up, gang. 10 a.m. hot zone with that consumer sentiment. There's not much else going on, so that one will have a lot more eyes on it. Thank you, as always, for your eyes. Thank you so much for being here for our Charts and Coffee, Caffeinate and Dominate, gang. I'll see you Sunday, 6 p.m. for our weekly look, our weekly prep for the new week. I'm really looking forward to the September trading season. Looking forward to seeing you all in the Sector Secrets Mastermind. Be good to each other, and I'll see you then.